What if I told you that some of the richest people in your city don't own a tech startup, don't have a single TikTok follower, and have never once gone viral? They own laundromats. They own parking lots. They own vending machines sitting in the corner of a gas station you drive past every single day. While everyone else is chasing the next crypto coin or trying to build the next unicorn app, these people are quietly collecting checks from businesses so boring that nobody bothers to compete with them. Today I'm breaking down 10 of these businesses, how they work, what they actually cost, what they actually pay, and the real risks nobody talks about. Stay until the end, because business number 10 has one of the highest profit margins on this entire list, with some of the lowest day-to-day effort required. Let's get into it. Why boring wins? Here's something most new entrepreneurs get backwards. They think exciting equals profitable. It doesn't. Boring businesses tend to win for 5 simple reasons. First, predictable demand. People will always need storage, clean clothes, parking, and cash. That doesn't change based on a trend cycle. Second, recurring customers. A laundromat doesn't need a new customer every day. It needs the same 300 people to keep coming back every week. Third, stable cash flow. When your revenue doesn't swing wildly month to month, you can actually plan, reinvest, and sleep at night. Fourth, lower competition. Nobody's making a documentary about vending machines. That means fewer people jump in, which means less pressure on pricing. And fifth, these businesses aren't dependent on trends. A car wash was profitable in 1985, and it's profitable now. No algorithm can kill it. None of this means these businesses are easy. It means the risk is calculated instead of chaotic. Keep that in mind as we go through this list, because execution is still everything. Here's what nobody tells you about this list. Most of these businesses don't make you rich overnight. They make you rich slowly, then all at once. Once you own 2, 3, or 4 of them. Let's start with number 1. Self-storage facilities. What it is. Self-storage is exactly what it sounds like. You rent out individual units where people store furniture, boxes, seasonal items, or business inventory. You collect monthly rent, and that's basically it. Why people ignore it? It sounds like real estate for junk. There's no glamour in a metal box. Most people scroll right past this idea because it doesn't feel like a business. It feels like a landlord's side hustle for boxes. How it makes money. You either buy land and build storage units, or you buy an existing facility. Tenants sign a lease, usually month to month, and pay rent whether they visit their unit once a year or never. You're not managing people, you're managing space. Startup cost. A small facility can start around $200,000 to $500,000 depending on land prices and location. Larger multi-building facilities can run into the millions. Costs vary heavily by region, so a rural facility in Ohio looks nothing like one near Los Angeles. Profit potential. Well-run facilities often see profit margins between 30 and 50% once they're stabilized and occupancy is high. A mid-sized facility with strong occupancy can generate anywhere from a few thousand to tens of thousands per month in net income. But this depends entirely on location, unit count, and how well it's managed. Biggest risks. Zoning laws can make it hard to build new facilities. Vacancy is the silent killer. An empty unit earns you nothing while property taxes keep coming. And self-storage is capital intensive, so getting started usually requires financing or partners. Real example. Public Storage is the most recognizable name in this space, and it became one of the largest real estate investment trusts in the country simply by scaling this exact model. Buy land, build boxes, rent them out, repeat. Beginner advice. If buying a facility feels out of reach, start by researching a franchise-style storage brand or looking into smaller conversion projects, like turning an old warehouse into mini storage units. Learn the numbers before you learn the paperwork. Would you put 6 figures into a business built entirely around empty space? Some of the wealthiest real estate investors in America would say yes without hesitating. Let's move to something almost everyone has used, but very few people have owned. 2 laundromats. What it is. A laundromat is a self-service facility with coin or app-operated washers and dryers where customers do their own laundry. Why people ignore it? It smells like fabric softener and looks like a business from the 1970s. There's no exciting pitch deck here, just machines, quarters, and folding tables. How it makes money. Customers pay per wash and dry cycle. Many modern laundromats have shifted to app-based payments instead of coins, which reduces theft and makes tracking revenue easier. Some owners add vending machines or wash and fold services for extra income. Startup cost. A single laundromat typically costs between $200,000 and $500,000, largely because commercial washers and dryers are expensive and often need to be purchased outright or financed. Profit potential. Laundromats commonly run profit margins between 20 and 35%. Monthly revenue can range widely. A small location might bring in a few $1,000s, while a busy urban laundromat can bring in tens of thousands, before expenses like rent, utilities, and maintenance. Biggest risks. Water and electricity bills add up fast. Machines break, and repairs aren't cheap. Location matters enormously. A laundromat in a neighborhood full of apartment renters without in-unit washers will outperform one in a suburb full of houses with laundry rooms. Real example. Many laundromat owners in major cities have built small portfolios of 3 to 5 locations, treating each one like an ATM that happens to wash clothes. It's rarely one location that creates wealth. It's the second and third. Beginner advice. Before buying, spend time watching an existing laundromat's foot traffic at different hours. Understanding customer patterns tells you more than any spreadsheet. Here's a fair question. Would you deal with broken machines and plumbing issues for $15,000 a month in profit? A lot of owners would say the trade-off is worth it. Now let's talk about a business that fits inside a hallway. 3 vending machine business. What it is. A vending machine business involves placing machines that sell snacks, drinks, or other small products in high-traffic locations and collecting revenue from every sale. Why people ignore it? It feels too small to matter. People picture a single machine in a break room, not a business. How it makes money. You place machines in offices, gyms, schools, or apartment complexes, usually through a revenue share agreement with the property owner. You restock inventory, collect cash or card payments, and pocket the margin between what you paid for the product and what you sold it for. Startup cost. A single new machine can cost between $3,000 and $5,000, though used machines can be found for less. Most people who succeed in this space don't start with one machine. They start with 5 or 10 to make the routes worth their time. Profit potential. Profit per machine varies enormously based on location and foot traffic. A machine in a busy office building might generate a few $100s a month in profit, while a poorly placed machine might barely cover restocking costs. Biggest risks. Location is everything, and a bad location will bleed you slowly. Machines get vandalized or jammed. And this business does not scale itself. Someone has to physically restock machines unless you eventually hire route drivers. Real example. Large operators like Canteen and Compass Group built multi-billion-dollar vending and food service operations, but they started the exact same way an individual entrepreneur does. One machine, one location, one relationship with a property manager at a time. Beginner advice. Start by cold calling small businesses in your area and asking if they'd allow a vending machine on-site for a revenue split. This is the fastest way to test the model with minimal upfront risk. Would you spend your Saturday morning restocking soda machines for extra income? Most people wouldn't, and that's exactly why this niche still has room. Speaking of things people drive past every day, let's talk about cars. For car wash business. What it is. A car wash is a facility that cleans vehicles, either through automated tunnel systems, self-service bays, or full-service hand washing. Why people ignore it? It feels like a low-margin, high-labor business. Most people assume you need a large staff and constant supervision. How it makes money. Customers pay per wash, or increasingly, subscribe to unlimited monthly wash plans. That subscription model has completely changed the industry because it turns a one-time transaction into predictable recurring revenue, similar to a gym membership. Startup cost. A self-service car wash can start around $200,000 to $400,000. A full automated tunnel wash with modern equipment can run well into 7 figures. Profit potential. Subscription-based car washes often report profit margins between 20 and 40% once membership numbers are strong. Revenue depends heavily on location and how many members sign up for recurring plans. Biggest risks. Equipment maintenance is expensive, and downtime means lost revenue. Water usage and environmental regulations vary by state, and the subscription model only works if you can retain members, not just sign them up. Real example. Private equity firms have aggressively bought up car wash chains across the country over the past several years specifically because of the subscription model's predictable cash flow, treating car washes almost like recurring software revenue. Beginner advice. Study the subscription pricing model used by successful chains in your region before considering ownership. The membership structure, not the wash quality, is usually what determines profitability. Here's an unexpected fact. Some car wash memberships have higher retention rates than actual gym memberships because people cancel gym plans out of guilt, but rarely cancel a car wash plan they forget they're paying for. Let's talk about a business that requires almost no equipment at all. 5 parking lots. What it is. A parking lot business involves owning or leasing land and charging vehicles to park on it, either hourly, daily, or through monthly passes. Why people ignore it? It's just asphalt. There's no product, no service, seemingly nothing to manage. How it makes money. You charge for parking access, often using automated pay stations or apps, which means you can run this business with very little daily labor. Some owners lease their lots to parking management companies entirely and simply collect rent. Startup cost. If you already own land, converting it into a paid lot can cost as little as $10,000 to $50,000 for pavement, signage, and payment equipment. Buying land specifically for this purpose can cost significantly more depending on the city. Profit potential. Parking lots in high-demand areas, like near stadiums, airports, or downtown business districts, can generate strong margins because operating costs are minimal once the lot is built. A well-located lot in a busy city can produce meaningfully more profit than the same size lot in a quiet suburb. Biggest risks. Location dependency is extreme. A parking lot in the wrong spot is just an expensive piece of pavement. Zoning and permitting can also be a slow, bureaucratic process. Real example. Some of the largest private landowners in major downtown areas make significant income simply by leasing surface lots to parking operators while waiting for the right moment to develop the land further. Beginner advice. Look for underused land near event venues, hospitals, or business districts, and research the local permitting process before assuming you can just start charging for parking. Would you rather manage 300 storage units or one parking lot near a stadium? Different effort levels, but sometimes surprisingly similar income. Let's talk about a business that's almost invisible until you need cash. 6. ATM Business. What it is. An ATM business involves placing automated teller machines in retail locations and earning a fee every time someone withdraws cash. Why people ignore it? Most people assume ATMs are owned by banks. In reality, a large percentage of ATMs in convenience stores, bars, and gas stations are independently owned. How it makes money. Every withdrawal generates a surcharge fee, often between $2 and $4, which goes to the machine owner. You negotiate placement with a business owner, usually splitting a portion of that fee with them for hosting the machine. Startup cost. A single ATM machine typically costs between $2,000 and $3,000. Plus the cash you need to keep loaded inside it, which can range from a few thousand to over $10,000 depending on machine capacity. Profit potential. A well-placed machine in a high-traffic location can generate a meaningful number of transactions per month, but income varies enormously based on foot traffic and whether the area is cash-heavy. Biggest risks. You need to physically restock cash regularly, unless you use an armored service, which cuts into profit. Machines can be targeted for theft. And digital payments are slowly reducing cash usage in some regions, which is worth watching long term. Real example. Independent ATM operators have quietly built portfolios of 50, 100, or more machines across bars, smoke shops, and convenience stores, treating each machine like a tiny recurring revenue stream. Beginner advice. Start by approaching one or two local business owners who currently have no ATM and offer a simple revenue share deal before investing in multiple machines. But here's what nobody tells you about this one. The real skill isn't installing the machine. It's negotiating good placement deals and managing cash logistics. Now let's move to a business built entirely around other people's mess. 7. Commercial cleaning. What it is. Commercial cleaning involves providing cleaning services to offices, retail stores, medical facilities, or other businesses, usually on a recurring contract basis. Why people ignore it? It sounds like manual labor with no scalability, and nobody dreams of owning a mop and bucket business. How it makes money. You sign contracts with businesses for regular cleaning, whether that's nightly, weekly, or a few times a week. Once you land a contract, it tends to renew automatically month after month, which creates very stable recurring revenue. Startup cost. This is one of the more accessible businesses on this list. You can start with basic cleaning supplies and equipment for as little as $2,000 to $10,000, especially if you're doing the labor yourself in the beginning. Profit potential. Profit margins in commercial cleaning often range from 10 to 30%, and they improve significantly once you hire a small team and manage multiple contracts instead of doing the work yourself. Biggest risks. Labor is your biggest cost and biggest headache. Turnover is high in the cleaning industry. Contracts can be canceled, and competition on price can get aggressive in saturated markets. Real example. Many regional commercial cleaning companies started as a single owner-operator cleaning one office building at night, and grew into companies managing dozens of contracts and employing crews of 10 or more. Beginner advice. Land your first contract before buying equipment in bulk. Word of mouth and direct outreach to small local businesses is usually more effective than expensive marketing in this industry. Would you knock on 10 office doors a week just to land one cleaning contract? Most successful owners in this space did exactly that in year one. Let's move to a business that manages other people's biggest asset, their real estate. 8. Property management. What it is. Property management involves overseeing rental properties on behalf of landlords, handling tenants, maintenance, rent collection, and day-to-day operations. Why people ignore it? It sounds administrative and stressful. Dealing with tenant complaints and maintenance calls doesn't sound like an appealing business model. How it makes money. You typically charge landlords a percentage of monthly rent collected, often between 8 and 12%, in exchange for managing their property so they don't have to. Startup cost. This is one of the lower capital-intensive businesses on this list. You can start with under $10,000 if you're handling operations yourself, though you'll eventually need software systems and possibly a small team as you scale. Profit potential. Managing a portfolio of properties can generate steady monthly income, and profit margins tend to improve significantly as you add more units, since your overhead doesn't grow at the same rate as your client base. Biggest risks. You're liable for tenant issues, legal disputes, and maintenance emergencies at all hours. Reputation matters enormously. One bad landlord relationship can spread quickly in a local market. Real example. Many successful property management companies started by managing a single landlord's small apartment building, then grew by referral as landlords recommended them to other property owners in the area. Beginner advice. Start by managing one property, even for a friend or family member, to learn the systems before marketing yourself to other landlords. Compare that to a laundromat for a second. Property management requires more people skills, less equipment. Different kind of boring, same kind of steady income. Now let's shift from physical businesses into something that lives entirely online. 9 digital products. What it is. Digital products are things you create once and sell repeatedly without needing to restock or physically deliver anything. Templates, courses, printables, stock photos, or spreadsheets. Why people ignore it? It feels too simple to be a real business, and many people assume the market is too saturated to break into. How it makes money. You create the product one time, then sell it repeatedly online through platforms like Etsy, Gumroad, or your own website. There's no manufacturing, no shipping, and no inventory, just creation and marketing. Startup cost. This is one of the cheapest businesses on this entire list. Many people start with under $500, sometimes with nothing more than time and a laptop. Profit potential. Because there are no physical production costs, profit margins can be extremely high, often 70 to 90%, since your main ongoing cost is marketing and platform fees. Biggest risks. Market saturation is real in popular categories like templates and printables. Standing out requires genuine marketing skill, and initial sales can be slow until you build an audience or master advertising. Real example. Independent creators have built 6- and 7-figure businesses selling things as simple as budgeting spreadsheets, social media templates, or digital planners, often through a single well-optimized product listing. Beginner advice. Start with one specific product, solving one specific problem for one specific audience, rather than trying to create a broad catalog right away. Wait till you see the next one, because it takes everything good about digital products and multiplies it. 10 Software as a Service SaaS. What it is. SaaS is a subscription-based software product that solves a specific problem for businesses or individuals, where customers pay monthly or annually to use it. Why people ignore it. Most people assume you need to be a professional coder to build software, so they rule themselves out before even researching it. How it makes money. Customers pay a recurring subscription fee, monthly or yearly, to access your software. Because it's digital, your cost to serve one more customer is nearly zero once the product is built, which creates extremely high scalability. Startup cost. This varies enormously. A simple tool built using no-code platforms or freelance developers might cost a few $1,000s. A more complex product built by a development team could cost tens of thousands or more. Profit potential. SaaS businesses often have some of the highest profit margins on this entire list, frequently exceeding 70 to 80% once a product reaches scale, because the same software serves unlimited customers without significant added cost. Biggest risks. Building the right product is genuinely hard, and many SaaS founders spend months building something nobody actually wants. Customer churn, meaning subscribers who cancel, can quietly kill your revenue if you're not paying attention. And competition in popular niches can be intense. Real example. Many successful SaaS founders didn't start with venture capital or a big team. They started by solving one annoying problem for one small group of people, then expanded once they found something people were willing to pay for every single month. Beginner advice. Before writing a single line of code or hiring a developer, validate the problem. Talk to potential customers, understand exactly what they'd pay for, and only then consider building. This is exactly why it earns the highest profit margin on this list, with some of the lowest ongoing physical effort. No inventory, no physical location, no restocking, just a product that keeps getting paid for month after month. Let's bring this all together. None of these 10 businesses are exciting. None of them will trend on social media. But that's precisely why they work. Boring businesses succeed because they solve everyday problems that people keep paying for, month after month, year after year, regardless of what's trending. Storage, laundry, vending, car washes, parking, ATMs, cleaning, property management, digital products, and software. None of them require you to be first. They require you to execute well, understand your costs, and manage the business with discipline. That's the real lesson here. It's not about finding some secret nobody else knows. It's about being willing to run the business nobody else wants to run. If you found this valuable, subscribe for more practical finance content every week. And let me know in the comments, which of these boring businesses would you actually start and why? I read every comment, and I want to know which one made you stop and think. I'll see you in the next one.